Hello and good afternoon, everyone. We'd like to welcome everyone on to today's event on tax-efficient employee share plans. It's great to host everyone and great to be able to discuss this really important subject with everyone this afternoon. If anyone has got any technical issues, please feel free to contact us using the chat function. And if you've got any questions throughout the event, please feel free to put your question in the Q&A box and we'll pick your question up and we'll be addressing these towards the end of today's event. So we're really here this afternoon to talk about employee share plans. And just to be really clear from the outset, right from the start, this means any scenario where employees get a slice or a share of equity ownership in the business, and whatever form that might take. And this is really a step further than any kind of bonus scheme, whether that's based on EBITDA or any other kind of performance measure. This really goes hand in hand with that, but actually goes further in that we're actually giving employees a slice of equity. So what we're talking about is where an employee gets a slice of equity so that as the business grows in value, they get a share of that growth. I guess what we're really finding is that that's becoming more and more relevant, more and more important to our clients, particularly in these three scenarios where shareholders thinking about some kind of sale or exit over the next 3 to 5 years, or where some directors are looking to step back, spend less time in the business, need to hand over to more management personnel, or others that are looking to grow quite rapidly in view of becoming more sale ready. In all of these scenarios, it's really critical that you have capable management people, personnel, or a management team that is properly incentivized and aligned with your goals, and particularly if business value growth is one of your goals. Often one of the best ways of achieving that is through a well-implemented employee share plan. So we've had a lot of questions about this subject over the years, and we really thought an event to cover these key questions and our thoughts and answers to those would be helpful. So the format of today's event is really a Q&A session. So we've picked out the most common questions we have on employee share plans, and we're going to address these in turn. And if you've got any questions of your own you want to ask today, please do feel free to put them in the Q&A box as we go through. Session's going to be quite brief, around 30 minutes. So if we don't get a chance to cover your question, we'll aim to address it after the event. You can click on a link following this event to book a call with us to discuss. So the key questions we're going to cover today on this slide here, it's just 7 key questions that we're going to take in turn. So I'm going to hand over to Jerry, who's joining me on the event today, to cover off on the first question here. Why is considering an employee share plan important? Over to you, Jerry.
Thanks, Carl. So I think we tend to find there's lots of different reasons why people consider an employee share plan, but we tend to find that these are the 3 main drivers, which are going to come up on the screen in a moment, which are essentially alignment, retention, and tax efficiencies. And just to unpack that a little bit, you've probably got key team members that are critical to your goals and plans for the next few years, or alternatively, you know that there's some key roles that you need to fill, you need to recruit for. So it's incredibly important to make sure that they are clearly goal aligned with yourselves as the controlling shareholders. You've got objectives for the business. You want them to be aligned with you on that journey. You also need to make sure that they are going to stay the course. They're not going to get poached or decide they want to leave and work somewhere else. Some interesting studies been done on the cost of replacing a key employee, and it suggests that the cost of replacing a key person can be 1 to 2 times their annual salary, or even more to replace. And this slide here really shows the kind of wide-ranging impact this can have. You know, when you start thinking it through, there's lots and lots of different implications of losing a key member of the team, and it's kind of difficult to quantify all of that, but you can see the impact it can have. Conversely, the next slide shows the positive impact and how powerful a incentive, a targeted incentive can be, how it can help to move you closer to your goals. And we'll see when that comes up on the screen in a moment. So these are just, again, some examples of the value of an effective incentive. Allows you to go the extra mile, those employees to go the extra mile.
Sorry, Jerry, we're just not hearing you at this point in time.
Sorry, Carl, are you hearing me now?
Yeah, that's good.
Apologies for that. So I think we were just focusing on the value of having the value of an effective incentive, which is where an employee share plan can help. If it's structured and implemented correctly, what we're looking to do is align the employees with the journey that we're trying to take the business on, growing the long-term value of the business. That's your ultimate objective as a business owner, and you want to be able to take the employees on that journey with you. So it's about alignment as a key objective, and also retention being a key objective here. We want to ensure that we've got an effective incentive in place, and also that there's an incentive for the employees to stick with us and help us achieve these growth goals. Over to you, Carl, to talk about how we can use an employee share plan to drive enterprise value.
Thanks, Jerry. So, question of how we can use an employee share plan to drive enterprise value. I think the key point here is that employees get some equity, which means they can really help to increase the value of your business. If they can, if they can help you increase the value of the business, then they'll ultimately get a significant reward at the end of it. So you can see that if key employees can grasp this concept, they'll have the passion and incentivization to really help you drive business value faster than you could do on your own, with the end result being a win-win situation. The original shareholders are better off, and the employee shareholders gain some substantial equity and reward at the end of it. So the more they can drive the value of the business up, the more they'll get out of it at the end. It's really all about ramping up the growth curve. So harnessing the latent energy and talent in the team to grow the value of the business more rapidly. As you can see on these illustrations here, what you'll find is that private equity do this all the time. They see it as critical to have an aligned and effective management team, particularly where there's a focus on increasing the value of a business and selling again in a relatively short time window. They're trying to achieve what you can see on this slide. They're trying to achieve rapid value growth, and they ensure that the whole team is aligned and incentivized around this by giving them an equity stake. And we'd really go so far as to say that an employee share plan is really the only way to actually hit your enterprise value target. And it really raises an important question. Have you actually got an enterprise value target? We really think that every business should have an enterprise value EV target that you're really aiming for, and that you would ultimately want to see the business worth. And once you've got that, it's a question of saying, well, how much of that do you want key employees to actually share in and get? So if you're thinking of looking at an employee share plan, we'd say to start with the end in mind, start with your ultimate enterprise value goal that you're aiming for in mind. Next question we've got here is, what are the tax implications of an employee share plan, and what are the options for doing things in a tax efficient way? Going to hand back to Jerry on this one.
Thanks, Carl. So I think firstly what I wanted to do was just touch on the basics of how an employee share plan works. So there's three phases to any employee share plan, and that applies equally to any type of scheme that you go for. The first phase is where you're either issuing shares or granting options to employees, and that's typically done at market value, so it avoids triggering a tax liability for the employee. But it's also important to do it in a way that doesn't involve any upfront cash outlay for the employee either, because usually, obviously, that's not it's not possible for that to happen. So that's the first phase. The second phase is the growth phase. This is where you're growing the value of the company, trying to get to your target enterprise value that Carl's just touched on. In this phase, but depending on the scheme that you have in place, dividends may be paid to employees, not necessarily, and care is needed, particular care is needed around this to make sure that it's done in the right way so it doesn't trigger negative tax implications. And in fact, is not necessarily any more tax efficient than paying bonuses through the payroll. So that's that's not necessarily the right thing to do, but it might be on some schemes. The final phase is the sale, a business sale or exit event. This is the big final outcome. You're selling the company, and everyone gets to cash in the growth in the value of their shares, including those employees that are on the scheme. So that'll be taxed in their hands at between 10 and 20%. And in addition, with a share option plan, typically the company will qualify for a corporation tax deduction as well. So just to move on and touch briefly on the different types of scheme. So there's three different types of scheme that we typically see and talk to clients about. The first is a phantom scheme. The second is a growth share scheme, and the third is a share option plan. So what we've done here is we've tried to just demonstrate the quite significant difference in the tax outcomes, both for the employee and for the company, between the different types of scheme. So what we've done for ease of comparison, and we'll show the other two in a moment, what we've done for the ease of comparison is taken a fixed net amount of £1 million that we want to end up in the employee's hands, just as a notional figure for ease of comparison. So for a phantom scheme, the net cost to the company, this is paid to the employees as a bonus through the payroll. So there's nothing particularly special about the way this is done. From a tax perspective, it's just taxed as a bonus. So the net cost to the company after claiming a corporation tax deduction, paying national insurance and so on, is 1.61 million. So that's an overall tax cost of 610,000. Let's now move to the growth share type scheme. Same net in pocket to the employees, but the net cost to the company to deliver that is 1.25 million. So significantly reduced overall tax cost of £250,000 in this example. And finally, on the share option route, so the same net in pocket for the employees, but the cost to the company is only 833,000. Now this depends a little bit on exactly which scheme you go for, but these are typical numbers. So if you look at that, you've actually got a net negative overall tax cost. So you've actually, there's an overall gain of 167,000. It's cost the company less than what the employee ends up with in their pocket. So it's clearly a very tax efficient route. What you tend to find with the different schemes is that with higher tax efficiencies, you do sacrifice a little bit in the way of flexibility. Share option plans tend to be based mainly around an exit scenario, so a business sales scenario, but there's a place for all of those routes. But what we just want to demonstrate is the significant difference in the tax outcomes. So this is obviously a very headline overview, and there's a lot more detail that has to go into selecting the right scheme and then designing it in a particular way that makes it the right incentive scheme for you and your employees. So, for example, this might involve building conditionality and staging into the scheme so that further shares can be issued to employees subject to certain requirements being met. The other thing is that we sometimes get the question, well, how do we know that these employees, we're going to set this scheme up and these employees are just going to kind of sit back and relax and wait for the money to roll in when we sell the business? And I think there's a number of factors at play here, including which employees you select to put on the scheme, which Carl's going to touch on in a moment. But it also comes down in particular to how the scheme's set up and designed in order to deliver an effective incentive and actually motivate the employees to work to achieve the right end result, which is your target enterprise value. So there'll be a little bit more detail on how we do that shortly. So I'll just hand you back to Carl to talk about which employees you should select to go on a scheme.
Thanks, Jerry. So it's a common question that comes up: which employees should or should you not include on an employee share plan? Guess it's because what we're talking about here is not just a bonus scheme, not just paying something through the payroll. What we're talking about here is giving employees an actual stake in ownership, giving them an actual equity stake. And so obviously this question comes up: which employees could or should you include? I guess it's possible to include any employee in some form of employee share plan if it's structured correctly. And if you've got particular questions about certain employees, we'll be happy to discuss any specifics. But you really want to think about where it's actually going to have the most impact. Start with your key people, C-suite, senior management people, and think about these questions. Would it be very detrimental to the business if they left? Would a well-designed long-term incentive plan actually help them to really throw every ounce of effort into growth of the company for you? And would you want them to share in the rewards of a successful sale? So they're really three key questions just to think about when you're thinking about who you might want to include on an employee share plan, which is really about giving key employees an equity stake in the business. Next question that we get asked often is how to actually maintain appropriate confidentiality when you're bringing key employees in as employee shareholders. So I'll hand you over to Jerry on that one.
Thanks, Carl. And this is a question that often comes up, is how we maintain the right level of confidentiality. You're going to have a number of employees that you're thinking of as appropriate for this scheme. There'll be other employees that don't necessarily fall into that category. And it might be important to ensure that this is kept confidential so it doesn't create negative implications elsewhere in the organisation. So where you've got employees that are holding less than 25%, it's possible to structure this so that full confidentiality is maintained. So there's nothing on Companies House. There's no visibility on the public record anywhere that they are shareholders. And no one, necessarily needs to know that they are shareholders. What we would say is that it is critical that it's set up right, and it's also critical that it's reported right to Companies House by your accountant. So that's important to make sure those things are done correctly. With a share option scheme, this is easier in the sense that there is no visibility on Companies House. It's share options, it's not shares. So there's nothing reported to Companies House that's on the public record. So with either route, the other side of this as well is that the agreements with each employee are individual. So even between employees on the scheme, it's possible to maintain confidentiality. What we would say, however, is you need to bear in mind that in an ultimate sales scenario, particularly your finance director or your key finance personnel will be involved in that process. They will have detailed knowledge of all the numbers and the whole process you're going through, because they'll need to be involved in that. You'll want them to be involved in it. So you need to think about how you manage that ahead of time. And what we tend to find and see in practice is that in practice the FD will be included in the share scheme at some level, at an appropriate level. Hopefully that covers that point.
Next question we've got here is how do we boost the impact of an employee share plan to motivate staff and maximise enterprise value? Already there's four key pillars that are really key to maximising the impact of an employee share plan. You might think, well, it's a question of just getting it in place and off we go. Hopefully that'll do the job. It's not really the case. There's really four key pillars to actually making an employee share plan really effective and really help to maximise your enterprise value. So Just going to run through those quickly. First one here we've got is selection. So just make sure you pick the right people. So we're giving these key employees a share of equity. And so you've got to pick the right people. You've got to go through those questions as we touched on just a little bit earlier, and make sure that you're including people that you haven't got any question about. I think if you've got any reservations about somebody's mindset, perhaps that's just a question as to whether you really want to include them on a share of equity. Having a tiered approach is really the second one. So this is about creating an incentive for employees to just push further and harder, to take enterprise value to the next level, take enterprise value to a higher level than you thought was possible. So this is really all about the design of your employee share plan. We're designing schemes now that have got different thresholds factored in, built in, so that employees get a bigger share when enterprise value exceeds certain targets and different thresholds. And that really provides a real incentive to push to the extra degree to get EBITDA up, get enterprise value up to the next level. We've got training. So as I said, you might think it's a question of getting an employee share plan in place and that's it. Don't really need to think about it again. However, employee training is absolutely critical if you want the whole employee share plan to be a success. So employees on something like this, they really must have a decent understanding of how enterprise value works. And they really need to understand exactly what they need to do to be able to drive the value of the business up. So they need to have some understanding of EBITDA, some understanding of multiples, some understanding of how the whole thing fits together. If they don't have that understanding, then the power of the motivation just isn't really going to be there. We're not talking about turning all your key employees into accountants or anything like that at all, but it's just giving them that basic understanding of how it works so they actually are motivated by the whole thing. They can see a direct line of sight as to how they can actually impact enterprise value and their reward at the end of it. And then linking very much with that, there's communication and reporting. It's really critical to involve employees right from the start. As soon as you know you want to do this and you know which employees are going to be involved, it's really important that you're communicating and involving them in the process. Give them a clear line of sight. So explaining what you're trying to achieve from the scheme, why are you actually putting this thing in place, and what's actually in it for them, how are they going to benefit from the long-term growth in value of this business, and just sharing the company's goals and how they can impact them, how they can impact the enterprise value, and show them how much they could actually benefit on an ultimate sale of the business. But there's more to it than that. There's really providing a scorecard, at least on an annual basis, possibly on a quarterly basis, just reporting on how the enterprise value of the business is actually performing, how's it actually going, so that they can see where they stand and they can see what their stake in the business is actually worth. And that really provides the extra motivation to push things because they can see exactly where they are, how far away they are from perhaps the next threshold, depending on how the whole thing's been designed. So there really are some key ingredients to make an employee share plan a success that are really, really important. It's not just about putting it in place and just hoping it will do the rest for you on its own. You do have to go through these four key pillars. The good news is that it's definitely possible to achieve all of these things as part of a robust setup and maintenance process. And these are all points that we've built into the way we approach implementing employee share plans for our clients. Just going to hand on to Jerry for the final question here. What happens when you come to sell the company?
So I think this is pretty straightforward. In the event of a final sale, any employees who've got shares or options over shares will sell their shares at the same time as everyone else. So the company is sold, including the employees' shares, and they get paid their proportion of business value based on whatever shareholding they've acquired. They pay between 10 and 20% capital gains tax on that gain, and they're responsible for reporting that and paying that on their own individual tax returns. One point that's perhaps just worth mentioning is that employees on employee share schemes, they don't have any particular say in whether or not you decide to sell, or at what point, or for how much, or anything like that. They are shareholders, but the decision on when to sell and how much to sell for, who to sell to, and so on, is that of the controlling shareholders. So the employees will exit the scheme effectively at that point. They exit the business at the same time as you do. Now, the buyer, for example, private equity, use similar schemes to incentivize employees, and they might decide to re-incentivize those key employees by giving them another round of shares. So they cash out with you when you sell, and then they might get another round if they're staying on as employees. Does that cover that, Carl?
Thanks, Jerry. That's good. So we've had lots of questions coming in as we've been speaking, which is great. Feel free to keep adding any questions you've got. Just before we move on to those questions, those Q&As from you now, the live Q&As, just wanted to mention that if you're interested in discussing employee share plans further, and you want to discuss the specifics of your situation, then we'd be more than happy to have a more detailed discussion with you. And there'll be a link sent through following this event on follow-up email where you can book a call with Jerry to discuss this further, discuss the specifics of your situation. I am actually just going to put a link on the chat now as well, that you can follow to book a call in. So just to mention, we've got a well-honed process that we take clients through to make sure all of those key pillars we talked about of a successful scheme are covered. So thinking about and brainstorming the target enterprise value in terms of what you really want this business to be worth when it comes to the end of it. Employee selection, so just thinking about actually who do we want to include on this scheme, who's right to be included on here. Communication and onboarding, so communication with key employees, explaining to them how an employee share plan actually works and what it actually means, helping to remove some of the unknown as far as employees are concerned that are going to be on it. And training and upskilling, so that's really about providing the training for key employees so they understand what enterprise value is, understand how it can actually be driven. So we've got some training modules that we provide to key employees on that. Scheme design and conditionality, so helping to actually design the scheme so it's got different thresholds so that it's actually got some real incentives in there for key employees to push forward. So, and then regular reporting, so actually providing that regular reporting so that key employees know where they stand, how are they actually doing compared to the targets and so on. What's their stake in the business actually worth now? So I'll just put the link there in the chat. So if anyone wants to discuss that in more detail with Jerry and wants to talk about more specific points, you can do that. And just one final thing before we move on to the live Q&As, just a point about the next autumn budget, which the date of which has just been announced actually by the Chancellor. So that's going to be on the 30th of October. And the Chancellor herself has said that tax rises are going to be on the cards as expected, predicted, whatever. So yeah, there's wide speculation that things like capital gains tax, inheritance tax, stamp duty, land tax, fuel duty, council tax, business rates could all be on the agenda to be targeted in this budget at the end of October. So just to make sure we're up to date with that, there'll be a link in our email following this event to register for our same-day rapid reaction 30-minute webinar, where we'll be distilling the announcements of the budget down into the key points you need to know about. And it's going to be important, I think, that you know about these tax changes, likely to be more changes than we've had in recent years. in this budget with the change of government. So going to move on to the live Q&As. I'm going to just run through the questions we've had here. So there's a few questions around EMI and what's the difference with EMI, and is this about EMI or is this different? Is this scheme different? Well, we're not exactly talking about any one particular type of employee share plan in today's event. We're not exactly zoning in on any one. Jerry showed us the table near the beginning of the event with 3 broad avenues you can go down when it comes to an employee share plan. The fact is that there isn't just a one size fits all approach. You've really got to look at your situation, look at what you're trying to achieve, look at what your goals are for the next 3 to 5 years. Do you want to sell, or what's the real goals of the business? And then you've got to really build it to fit those goals. And the tax implications of the different routes are all quite different and want to be taken into account as well. So I think that's the answer to that. I don't know if you've got anything to add to that, Jerry.
Yeah, I mean, I think EMI gets a lot of airtime, if you like, gets a lot of coverage in commentary, mainly because it's generally regarded as the most tax efficient scheme. It's not necessarily always the best one for everyone's circumstances. So it depends on what outcomes you're looking for, what your key priorities are. So I would say it's important to get someone that can take you through all of the different options, not just talk about EMI, because it isn't necessarily the right thing for you and your business and your employees. That said, it is a very good scheme and is a very good fit in certain situations. So certainly not writing it off, but you just need to make sure you're aware of the different options.
Good. So got some more questions around how something like this interacts with bonus schemes. Well, I think try to make it clear earlier on that this is different to any kind of bonus scheme. This is really about involving key employees by giving them an equity stake. So they actually have a small slice of ownership. And as the business grows in value, their proportion, their slice of value is obviously going to increase along with that. And that's really one of the key points about an employee share plan, isn't it, Jerry?
Yeah, that's right. So an employee share plan sits alongside and complements and works alongside a bonus scheme. Bonus schemes tend to be short-term, annual based. This is talking about long-term equity.
This question about covering or dealing with long-term sickness or non-attendance for an employee that gets included on employee share plan, I guess might also go hand in hand with questions around what happens if an employee actually leaves that's on employee share plan, or what happens if you have to dismiss an employee that you've put on an employee share plan. But basically, the key to that is the setup of the whole thing in the first place, making sure it's been set up right. If you've got the proper agreements in place, leaver provisions, etc., right at the start, at the outset, when the thing is set up, that means that the employer would automatically forfeit their shares if you have to dismiss an employee that's on the scheme. And that means that the employer buys the shares back at cost. Or if it's an option type agreement, the option lapses, so they just don't have the option for those shares anymore. So they're the kinds of things that can be put in place as part of the setup, or are normally always put in place when we're setting them up as part of the setup to make sure that you're actually protected as an employer. Anything to add to that, Jerry?
No, I think that's quite clear. That's dealt with pretty comprehensively by the leaver provisions, typically in the agreements, and that would cover things like long-term severe health issues, or an employee either leaving or having to be dismissed. Is all kind of factored into that.
Got a question about can you not just wait and see how much I actually get when I sell the business? and share some of the proceeds net of tax as a gift to employees at that point in time. I don't know if you can answer that one, Jerry.
Yeah, I mean, it's a question that comes up quite often. And I think there's a couple of kind of issues with that, really. One is it doesn't work very well from a tax point of view because any, if you like, gifts that you make to employees out of the sale proceeds, you've paid tax on them, and also the employee will pay tax on them as well because it's employment income. Even though it's a gift out of your own net tax paid income, it's treated as employment income for the employee. So it's not doesn't work well from a tax perspective. The other thing is that I think from the point of view of being an effective incentive and helping you to realise that target enterprise value, realise those growth goals, I'm not sure that it necessarily fulfills that particularly well either. Again, it depends somewhat what you're trying to achieve. But if that's your goal, then you're better off setting that out for the employee beforehand, so that everyone knows what they're aiming for and what they're going to get out of it at the end.
Good. Thank you. Well, I think that probably brings us to the close of the event, unless you've got any points to add, Jerry.
No, I think the questions that have come have been helpful and helped us to kind of elucidate some of those points. Obviously, if anyone does have any further questions or specifics on their own particular circumstances, we'd certainly encourage you to reach out. We're very glad to have a chat.
Thank you very much for joining us. Very glad to have you on this afternoon's event. Look forward to seeing you again. Thank you.
Thank you.